Hello and welcome back to Dukascopy TV. Now in the studio today I have Francois Nordhof, the Chief Investment Manager at BCP Bank here in Geneva in Switzerland. Today we're looking at alternative investments and the important role they play, or not as such, in the financial global crisis. Francois, thank you very much for coming into the studio today. Now, you noticed there I mentioned in the intro about the importance of alternative investments, or the lack of. We've got the fiscal cliff round the corner at the moment. Everything's a little bit in the air. People aren't really sure how it's going to play out necessarily. As far as alternative investments are concerned, what are the surprising winners, perhaps, in this current environment?
Yeah, the surprising winner in case of a fiscal cliff is not equities, not bonds, it's not real estate, it's not art, it's not wine, it's not collections, it's not jewelry. It's unfortunately going to be cash. And this is indeed not speaking in favor of a huge amount of transaction for bankers, because to hold cash is indeed extremely non-productive. But in fact, if we are facing a fiscal cliff, it's probably the only asset class that is going to survive, because indeed, as you are staying in cash, mostly in your home currency, your residential currencies, you can afford the impact of a fiscal cliff, and very easily, and you will be able to be the first investor to reinvest the conventional or the alternative asset classes. You will be the first one to benefit of a crash of the financial markets.
I had a couple of people tell me the other day about swagger investing, which was silver, wine, art, gold, energy and real estate. Just looking at some of these alternative investments, such as, say, wine or art, they were telling me that these areas are going to be essentially the key areas to invest over the next 2 or 3 years. Do you agree with that?
To a certain extent, yes. I mean, some of them, like real estate, were really a runner in the last decade. When we make abstraction indeed of the subprime crisis in the US, for instance, for real estate, but subprime crisis was really a specific segment of the real estate. And in all those asset classes, you need to make really the distinction between the high premium segment, which is interesting for an investors, and the lower end of the segment. And for real estate, it's really flagrant. I mean, it's impressive, the distinction that you have between top location real estate and a location somewhere on the countryside. It's like comparing a flat in Chelsea with a flat in the middle of Derby in the Midlands. I mean, you are not going to be comparable returns, to have comparable returns on this specific asset class. Regarding the other asset classes, in alternative asset classes like wine, like art, like collectors, you may invest in these asset classes, but keep one thing in mind: it's extremely illiquid. But these types of investments, if there is a fiscal cliff, if we are going into a recession or a huge depression, these investments are not going to return any high return. They may, to a certain extent, maybe preserve to a certain extent your wealth, but they are not going to perform positively. I mean, wine is made to be drank and not to be collected.
I'd agree with you on that. Finally, moving ahead, looking ahead, we've got a graph here. This is the Standard & Poor S&P 500 index. Looking ahead then, what can you tell me about this? Because there's maybe perhaps a bit of hysteria. We were talking before the interview, and that you can see here we've got a doubling here in price. Can you just talk me through briefly through this graph? Yeah,
actually, financial conditions on the conventional financial markets are extremely rich. I mean, the financial condition index that you can have on different systems are on the top, historical top. And therefore, we have it also, the reflection of this is here with the Standard & Poor 500 market, which doubled over the last 4 years. I mean, very few people are aware that the Standard & Poor over the last 4 years doubled, which means doubling in 4 years means a an annual return of more than 21%. I mean, there is a little bit of euphoria in the market, and if we would have a fiscal cliff, the confirmation of a fiscal cliff, which is probably not going to happen, but if we have, assume we have a confirmation of a fiscal cliff, then indeed you would see all big broker houses promoting currently equities turning very bearish, because this is for me the reflect of a bull market. A bull market is a market in line 4 years plus 21% of annual return is a bull market. And indeed we can explain this bull market with a rise in profitability of the American companies. I fully agree, but the profitability improvement, the margin improvement within the American corporate sector has some limits, and we are currently reaching those limits.
Just finally, Francois, we have the Dukascopy question, which is a bit of a tradition here, which is if you had $1 million US, which of these areas would you invest in? Just one. We've got real estate, equity, bonds, gold, cash or oil.
Despite my previous message, I would invest in equity. Why? Because I do not believe in a fiscal cliff, because there are different factors that are telling me that we are going to avoid a fiscal cliff in the US, also the one in Europe, but in the US specifically. And therefore I would invest in equity, and more specifically I would, and I am currently invested, for instance, in Swiss banks, but I would also add, and I will probably add to my own portfolio, some Spanish banks to my equity portfolio, because the big players in Spain are indeed exposed to the domestic country, but are also extremely profitable in Latin America and in other parts of the emerging area. Therefore, it's probably a good investment to look at.
Along with your wine investment, which I know you're in. Francois, thank you very much for coming in the studio again today. Thank you.
Has been a pleasure.
That's all we've got time for today here on Dukascopy TV. Stick with us throughout the day for the latest updates and exclusive interviews. Until next time though, goodbye.